Hey everyone, and welcome to Startup Savants. I'm Annaka.
And I'm Ethan.
If you're a returning listener, welcome back. And if you're new, this podcast is about the stories behind startups, the founders who run them, and the problems they're solving. This episode, we're joined by Jules Miller, one of the partners at Mindsetventures. Jules is a former entrepreneur turned venture capitalist.
So Jules isn't a founder. Well, at least not right now. Jules is a VC. That's right. We're switching things up a little bit this week. Instead of getting a founder story, we're going to get some insight from Jules on the basics of venture capital. She talks about who should and who shouldn't be raising venture, what her firm looks for in startups, and some common mistakes founders make when pitching investors.
This conversation is a must listen if you're thinking about raising VC funding, or even if you're just curious about what VCs are all about. So let's get into it. So if you could just start off, tell us a little bit about your background and how you got into venture capital.
Great. So I'm a venture capitalist, and it's very interesting. I did not expect to be a venture capitalist. I started as a founder myself. First I was in the corporate world. I actually started at a Big Four accounting firm. So not maybe the most traditional entrepreneurial path, but I was an entrepreneurial person. I started 2 companies. And just once you get in it, it's very hard to go back and do something different. So the more and more I got into the startup world, especially high growth tech startups, which is what I tend to focus most of my energy on. I just decided that this was the only thing that I could possibly do with my life, that it is the most interesting and exciting and fun thing to do. It is also still finance, right? So I think VCs there's sometimes some misconceptions about what VCs do. We, at the end of the day, are kind of like a service provider. We provide financing to a very particular type of company, and we can talk about what is a good candidate for venture capital and what is not a good candidate for venture capital. But at the end of the day, I get to hear a lot of really exciting ideas, see really incredible founders execute on those ideas, and hopefully change the world in some small little bit.
Perfect. And you've mentioned a lot of things already that we're itching to know about, so excited. And for anyone who might not know, if you could tackle 2 of the big finance buzzwords, the difference between angel investors and venture capitalists.
Angel investors are individual investors who are usually investing their personal capital. So that could be, and I do some angel investing on the side too. That means, I have some money in the bank and I decide that instead of, buying real estate or spending it on other things, I want to invest in high growth startups. So that's an angel investor, usually smaller check sizes, faster decisions because they don't have to talk to anyone else. They're doing things on their own. And they also tend to not set terms and lead deals in the way that traditional venture capital funds will. So a venture capital fund will invest a check, and we are professional, full-time, dedicated people that are doing investment as a career. And we usually also have raised funds from outside LPs. So LPs are the limited partner in our fund. So we also have to raise capital, and we also feel extremely responsible to our investors to make sure that we're deploying that capital in the best possible companies. And so it's just a different stage. We usually write larger checks. We can also set the terms. So we would be a lead investor. There's a difference between a lead and an investor who joins around that is not the lead. And so these are things that just professional venture capitals are the next stage after angel investors. Some angel investors end up being full-time venture capitalists. Some do not. Some venture capitalists angel invest. Some do not. There's some concentric circles around both of those things. But overall, we're both investing in innovation. But venture capitalists are full-time professionals, usually managing other people's money, and angel investors are individuals usually investing their own money.
Good explanation. Thank you for that. So you've experienced the founder side of the entrepreneur equation, but you've spent more of your time on the investor side. What led you personally to make the choice to go to the investor route? And do you ever see yourself founding another scale company?
Great question. So I think that I love being an entrepreneur. I was always very entrepreneurial. I built things. I like creating things. And actually, as an investor, you don't necessarily get to create. You get to support founders doing amazing things. I think that high growth startups are extremely intense to build as a founder. So I was, barely sleeping, was like, you're doing, 100 hours a week, dedicated, especially at the early stages, dedicated to building your business. You literally eat, think, dream, sleep, talk, walk, everything is about the startup. I'm not saying that's healthy, but I'm saying that's typically what you need to do and that intensity level that you need to do in order to create something from scratch and something from scratch that grows extremely fast. And we can talk a little bit more about what that means, but not every business is a startup. You may be a founder of a company, but it may not actually be a startup. That growth pace, that intensity, that pace of growth, that scale is something that is really, really important when we differentiate between a typical business and what is considered a startup. I will say that I didn't intend to be a VC. How I got into it was I felt that there were some opportunities to improve on the VC landscape a little bit. So I was a founder raising capital. I had and both of my companies that we raised capital for were other females. This was, 2012, 13, 14, 15. We were raising capital. It was clearly not a meritocracy. There were not a lot of women on the other side of the table when we were raising capital. And so I ended up joining the venture world because I wanted to fund more women and people of color and diverse, non-traditional founders. And that was really how I got into the space. I no longer focused out on that exclusively as a thesis, but I always do that as just a human who cares about that. I make sure that my pipeline is full of founders that aren't just the typical kind of Stanford dropout, coastal tech bros, and I make a really concentrated effort to do that. And I think the only way you can change an industry is by being in a position where you can actually make decisions. And in our world, that means writing checks.
Do you feel like the landscape has changed quite a bit since you got into the VC side?
It has certainly changed. Has it changed enough? Probably not, but venture capital is relatively slow cycles, right? Our fund lifetime cycles are, 10 years. We have 5-year investment periods. So it is changing. I'm very positive about the change that I'm seeing. There's a lot more, for example, diverse partners on venture capital employee. If you're looking at the investment teams at some venture capital funds, most of them have a little more diversity than they had, but it's not probably enough. And there is real effort and there's real momentum around investing in companies that have more diverse founders. I will say that the check sizes are still much lower. And so while there's a lot of talk about it, there's a lot of enthusiasm, there's a lot of support. I always think that this should be very market driven and there need to be more people going, this was where I always came from, is this is a big opportunity, and not that this is charity. This is not, doing something good for the world. This is actually amazing founders who are just not having access to capital, who are going to do big things, and I'm going to have high returns from it, and therefore I'm going to put in a bigger check. That still, we have some progress to make there, but I think we're getting there, and I think we'll get there, in the next 5 to 10 years.
So as a past co-founder, what are the biggest lessons that you learned from the founding side that you've taken to Mindset Ventures?
Yep. So 2 things. It's about growth and people. Those are the only things that matter in startups. And so the 2 things I always look for is from my side, is it the right team? Are they not only smart and capable and can execute on their vision, and have executed on their vision? I don't invest in pre-product companies or pre-revenue companies, but have they shown that they can actually execute? If I put capital in, will I get more capital out? And so the team has to be really strong, because that is something that this is not an easy space. Starting a company, building something new, especially something that has a potential to change an industry or change the landscape of the thing that you're working on in some way, it's hard. There's new things, and you have to trust that not only the team can do the thing that they're doing now, but they can do the 20 things that they don't even know they need to do in the next, the next 5 years. And I think for me as a founder, that lesson was very clear when I was hiring, when I was selecting my co-founders, when I was working through the process. There were some limitations. Like, we had some people on board who were amazing, and we had some people that maybe this was not the right path for them, or they didn't understand what it meant to be a high growth company. And so I think that there are certainly really lessons that you learn only by being in the trenches with people and seeing what they're made of. I think the second thing, which is aligned, is that everyone needs to be on the same page that this is a high growth company, and the company cannot grow 10, 20, 30% a year. It has to be growing 200, 300, 400% a year. And that's a very different type of business than most entrepreneurial ventures. And so that type of just, intense focus on growth is what makes a startup, in my opinion. And that is something that not only, I think maybe I underappreciated when I was a founder because we were so worried on getting it right. We didn't necessarily want to grow too fast, but as an investor, I look for companies that that are already growing that fast, or if they're not, have the potential to if I write a check.
That amount of growth just overall to me just boggles the mind. But I know that's what we like to see. And you've spoken a little bit about the things you brought into Mindset Ventures from your founder experience. For other founders that are kind of learning about VC and investment, what types of startups, stages, and attributes would be ideal for venture capital investment?
Yeah. So venture capital is diversified as an asset class in some way, meaning we're all looking for high growth. We're all looking for big returns in a reasonably short time period. So 5 to 8 years is typically where we'd want to see an exit, meaning you go from me writing a check to you returning my capital either through an acquisition or an IPO in a pretty short time horizon. So that's 5 to 8 years. I think that being said, there are different stages of venture capitalists. So I invest in seed to Series B. So typically that means there's some sort of product launched, there's some sort of traction and product market fit. There's some sort of ability to sell, and there's some sort of ability to show that you can scale the business. There are lots and lots of really great venture capitalists who focus on pre-seed and seed, which is idea stage, MVP stage. Not as much as I need in order to make an investment for my fund. And then there's growth. So I'm kind of in the middle there. And then there's growth capital after that, which only invests in kind of Series B, C, D, and onward. And that would be companies that are really on a growth path already and just need more capital to grow and to hit that inflection point where they can then either get bought or sold on the public markets. I think that each stage is venture capital, and we're all looking for that growth, but each stage carries different amount of risk. So at the early stages, you always trade off risk for ownership. Mm-hmm. So at the early stages, if you are investing capital in a pre-launch company, meaning there's no product, you're just investing in the people, you would typically write smaller checks, and and there's a high amount of risk. So if you're investing only that in your portfolio, then probably most of those companies will not exist. But the ones that do, you will have a high level of ownership in that company when they eventually go public or get acquired, in which case your returns will be high. The later you go, the lower risk there is, and as a result, the either higher price you pay and or the smaller amount of equity you own after the deal. And so it's all correlated, and everything is basically assessing the risk and providing some value for that risk. And so this is a very, very high risk investment area. So we're in the most risky investment area, whereas you can do pretty much anything else that has real assets. So again, like real estate, public markets, all of those things, there's of course risk, but you're probably not going to lose all of your money. There is a real chance that every single deal that we invest in, we will lose all of our money. We will probably not have 100% return hit rate on our companies, meaning we don't expect that every single one of the companies we invest in will be successful. If we do, it means we're probably not taking enough risks and we're not really venture. Yeah. So this is an extremely high risk industry to be in, and we do expect that companies will fail, but we expect that the ones that win big will go very, very big, very fast.
Dang. I'm learning so much. And then on the flip side, are there attributes or startups that absolutely should not consider taking on venture funding?
100%. And I think people don't necessarily always understand what venture is and think they want to raise venture and actually do not. So the two things, again, we're hitting some common themes here, but I can't drive them home enough, is if you are not prepared to grow 200, 300 more % a year, you should not take venture capital. That is what venture capitalists expect. And if your business doesn't support it, or you just don't want to grow the company that way, and that's completely fine. There are great businesses that are built and more solid businesses that are built, growing much smaller amounts year on year, but that is not what venture capital is all about. And so you need to understand what venture capital is, and it's to fuel very risky, rapid growth businesses. And if that's not your path, don't reach out to venture capitalists. I think the other thing is that you do need to understand that most venture capitalists, especially when they're leading around, will take a board seat. So if you want ultimate control in the business, meaning you don't want external people to be on your board and have big pieces of equity where they can influence the outcomes, then also do not take venture capital. Part of what we do is we're clearly not running the business. That is not our job, but we are there to provide oversight and direction. And our job is, if the CEO is not performing in the way they need to in order to make the company a success, then there is real responsibility and accountability for that. So you do need to be prepared to have an external board and have the venture capitalists that you're partnering with take a board position there and own enough equity to actually have some influence on the direction of the company. So that's not for everyone as well. Again, no right answer, but just know what you're getting into. And then the last thing I would say is, if you need to, this is a harder one to articulate, but I would say if you are not comfortable doing things in a way that you are taking risk and you don't know the answers to everything and you're not learning every day, if you're someone who likes to know details and make thoughtful, smart decisions over like a longer period of time, that's probably not a venture-backed business either. Like you've heard over and over from me, the blistering pace that growth is happening means that you're making decisions regularly without full information, without the time necessarily to do like thorough analyses of every single decision. And that's why it comes back to us always for the team. So if you can't trust, for example, your CTO to do everything on the tech without your oversight as the CEO, then that team's probably not ready to scale at this pace, because it's just not possible to do things in this way if you're making decisions if the CEO needs to be involved in every single decision and needs time to process the information that's there. You just have to move fast. And sometimes that means, as very famously Facebook says, move fast and break things. It's not always the right situation. It's not always the right outcome, but that is the general mentality.
Yeah. Man, I think being an entrepreneur is like not on my short list, but move fast and break things, I think I need tattooed on me somewhere. So
he's recently changed that. I heard him on the Tim Ferriss podcast, and his new saying was "move fast," and who knows, because it was considerably less sexy than "move fast and break things."
It was, and I think that the difference is now they're a big company,
yes.
right? And I think that at the beginning, moving fast and breaking things is how you get traction and how you at least prove the concept. The concept works. When you're a big company, the more things you break, the more shareholder responsibility you have and the more liability and all sorts of things. I think with startups, I'm not, especially in enterprise software, so I focus, there's consumer and enterprise. Consumer means selling to individuals, and enterprise means selling into businesses. I tend to focus mostly on enterprise software. And in that space, sometimes you also can't break things. Like there's things like compliance and there's like, data privacy and things that also you don't necessarily want to break. But I think you need to know the things that you can break and move fast at the expense of those things that are not as important, and then focus on the things that are important and don't break those things. So it's a little more nuanced, yes. And I think Facebook realized that. But at the beginning, the mentality and the ethos is partially correct to the degree that you can't do everything perfectly when you're moving at that speed.
Absolutely true. And you talked a little bit about the relationship between the startup founder and the VC. What does the ideal relationship look like there?
It should be more of a coaching or mentorship relationship than anything else. And so part of what we look for also is founders who I want to work with, who I think are responsive. They certainly do not have to take my feedback. And actually, I don't want them to take all of my feedback and suggestions, but I want to form a good relationship where we can talk openly about hard things. We know that this stuff is hard, right? Every venture capitalist has been in the space. If we're not expecting you to go, everything's perfect, we're going according to plan, 100%, like everything's great. That means that you don't have a great relationship with your investor. What my favorite founders to work with are the ones that we've built trust, we've built a relationship, and they're texting me nonstop, and we're meeting on a regular basis, and we're talking through some really hard stuff. So what happens when someone's not performing? Can you fire them? Do you need to coach them? Like, do you have time for that? How do we get them to the right position? Can we change their location? There's all these sort of little nuanced things that I've seen a million times now, both as a founder and then also with now we've got almost 60 portfolio companies. So these are patterns that I can help provide insight on. It doesn't mean that it's the right answer, but having these conversations, getting an opinion from someone who has seen more data points and seen what works and what doesn't in some way is extremely helpful for founders. But it also means being a little bit vulnerable, being able to share those things and working through them together. And so that is my preferred relationship with founders. Of course, we have some founders who are just, off on their own path, and they don't need support and guidance at a certain point, or at least from us. Maybe their later stage investors do. Mm-hmm. At this point, we have several unicorns in our portfolio. But what I would say is, this is a people business and it's about relationships. So the best possible outcome is working with someone who is not just a yes man, is not just a gloss over every hard thing. It's like that you have a real business relationship, that you trust each other and you can talk about the things that are important to the company together and work through solutions.
We recently had another founder on the show, Evan Buist of Melody. Great episode. If you haven't heard it, go check it out. He told us about a lesson he learned when pitching to investors, and that lesson was not to bring a 50-page pitch deck. Do you agree with that? What makes a good pitch deck, or just a great pitch in general?
Yes, never bring a 50-page pitch deck. Nothing to do with that. And also it shows me that you can't prioritize the information that's important. So like it or not, a pitch deck is kind of a proxy for how you think and how you articulate your business. And who was it? Was it Mark Twain said, I would have written something shorter if I had more time. This is having even very complicated businesses, articulating and being able to share the key points that are important in a short amount of slides and a short amount of discussion is really your first challenge as an entrepreneur, right? Can you articulate what you're trying to do clearly, directly, and in a concise way? And the pitch deck is the mechanism that we use for that. So I would say 10 to maybe 20 slides max, no more than 20 slides. I tend to see like 10 to 12 is probably at least for the first presentation. You probably have a lot more information than that. They go find in an appendix or a data room. So the typical way you would approach a VC. So again, this is a relationship business. It's about people. So you don't go into a first date, for example, sharing everything about your life in all sorts of minute detail. You don't bring your parents to the first date. You don't do all of those things. So what the intention is this a company and is this a founder that we are interested enough in not writing a check? Then you will almost never get a venture capitalist who will write a check after you've walked them through your deck for 30 minutes. But is this someone that I want to learn more from? And that I'm interested enough to do my own homework? Because the steps for raising capital are, number one, you get an introduction. Number two, you usually do your pitch, and the pitch should be able to be done in 30 minutes, right? My intro calls with people are usually 30 minutes. Sometimes an hour, but very rarely. And I find that the last 30 minutes are not particularly useful. Usually in 30 minutes, I know if I'm interested enough to look further or not. Then we go and do our homework. It's called due diligence. And what that means is you usually have a data room, meaning like a Google Drive or Dropbox folder somewhere where you have other information about the company. That can be all the other, the other slides, all the other details. There's usually a pretty rigid format of the stuff we look for: cap table, financials, sales decks, go-to-market strategy, backgrounds on the founders. It's the 5 T's: team, TAM, which is the total available market; technology, so a little bit more about your product; traction, so what have you sold, or how many users do you have, and what does that look like, and what's the projection on that; and then terms, so what kind of deal are you looking for, or how much are you raising, do you have deal terms, that type of thing. So those are the 5 things we really do deep diligence on. And then there's multiple phases after that. It ends so usually there's back and forth, Q&A, all sorts of things. And then the final stage is usually there's a full presentation to our investment committee. So we have a 5-person investment committee. Every founder comes in and presents to us, and then we do a discussion afterwards, and we vote, and we decide if we want to do the investment after that. So the pitch deck is not the end all be all. The pitch deck is the door opener. And if you come to the door with too much information, it's usually not appropriate for that particular meeting, and it probably won't progress after that, because I also see that you don't really understand the process and you don't really understand the game. So step 1 is really just understanding that this is like a multi-step process and what is appropriate for each step along the way.
I feel like you could probably write a book on those 5 T's. So we'll wait on that. And then, whenever that comes out, we'll will scream it at the top of the rooftops. When your firm decides to invest in a company, what is the general target of return that you're looking for in kind of a percentage of growth and timeline? And you've already said 200, 300, 400% per year over, 5 to 8 years. But when it's to the end, to that point where they're IPOing or selling, what's the overall percentage growth that you guys are kind of looking for in that?
Yep. So it's more based on valuation of the company, right? So what we're looking for typically is at least a 10x return. Meaning, if I invest $1 now in your company that's valued at $10, in 5 to ish years, you will be worth at least $100, right? So that's a 10x return. Obviously, the numbers are much bigger when you're talking about valuing a company, and I think the multiples are different too, depending. So it's not just about revenue, right? Because in each industry, the revenue multiples are different for acquisitions or for IPO. So in some industries, it might be, if you make $5 million, you would be valued at $10 million. So there's a 2x multiple on revenue. In other industries, it's a 20x. It kind of depends on what it is. But what we're looking for is a return on our ownership value. Meaning, so whenever we invest, the way venture capitalists invest is I pay you for a percentage ownership of your company. So I'm giving you cash, and in return, you are giving me equity, meaning you're giving me a percentage of your company. And that equity needs to appreciate in value by 10x at least in order for me to feel excited and good about the investment. So that's the path. There's lots of different details around that. But every investor will be looking at companies that they think that they can get a 10x return on that initial investment.
And is that over that 5 to 8 year period, or any different than that?
Yep. That's about the time period, because those are our fund cycles, right? So there's like real tactical reasons for that. Number one is just you have to grow that fast in order to really have high impact on an industry, and get to the scale that you need in order to do big things. But more importantly, it's because just on a tactical level, our fund cycles. So when we raise a fund, we have a 5-year investment period, and then up to a 10-year period that we can still manage that fund. After that, we actually don't really manage that fund anymore. And any investments in that fund, if they're not exited by that point, it's actually very complicated for us to figure out what to do with them. So it's just, there's some real issues with that. And so you just have to know. And also, so when we invest in the fund cycle is also really important. So if I just raised a fund and closed it yesterday, and then I invest in you tomorrow, you probably have a little more time before I'm going to start be pushing you to a really fast exit. If I invest at the very end of my fund, you're going to have a shorter period of time to invest. So it also influences the types of companies that we invest in depending on the fund cycle.
That's an interesting concept. I don't think I've ever heard that in any of the VC conversations that I've been privy to.
It's always worked, by the way, for founders to ask, how much money, when was the last time you wrote a check? Where are you in your fund cycle? How much do you typically invest? This should not be a one-way conversation. Founders can and should be asking investors more about their fund, more about the check size, more about where they're in their fund cycle, because all these things are important to figure out the fit. Venture is not a reflection of whether you're a good company or not. Venture is a reflection of, are you a fit with this investor's thesis, with their expectations for what you're planning to do, with their own fund dynamics, whatever that means. And so this should not be, if you're pitching VC after VC after VC and they're not interested, don't take that personally. Take that as that's just not the right business for that particular investor for a lot of reasons. It could be that it's not a good fit for venture capital overall. It could be just that investor has different ideas of the things that they want to invest in, and it's not a reflection on you at all. So it's about fit.
Once a company takes on venture capital, is there any other path to, quote, success other than selling or going public?
Those are the two traditional paths. And honestly, it's the outcome is that you have to return capital to the hands of your investors. I guess there potentially are other ways to do it, but I haven't seen it, right? So it is really about getting liquidity for your investors. And that means how do you convert their equity ownership into cash for your investors? And that usually means that someone is buying that equity from them. And that's either a bigger company who's acquiring you or the public shareholders for an IPO that they're buying that stock from you. So you could do things like, the founders could buy back shares or something like that, but then that almost never happens, and usually the returns are very low. You could do a secondary offering, meaning like sometimes early stage investors, as the company grows, will have the opportunity to sell off a piece of their shares to later stage investors. Like if SoftBank comes in or Tiger comes in, sometimes they'll buy stock from the earlier investors at a pretty good return. But those are not necessarily unusual, but those are not the best possible outcome. So it really is almost exclusively going to either the public markets or to be acquired by a bigger company.
What is the most common reason that the startups that gain VC investing, what's the most common reason that they either see their growth slow or just stop entirely?
So I think a lot of the reason that startups don't succeed generally is people reasons, and all of this gets minimized the bigger the company is. But at the earlier stages, so there's inflection points, right? At the earlier stages, again, it's all about the team. Can the team work together, problem solve? Are the right people in place to do the right things? And we try to invest in things that we think have the potential to be big. So if they did not get big, it's usually a people problem, especially if it doesn't work at the early stages. At the later stages, there are other things that could happen. So it could be competition. It could be things around, the customer base, and could be pricing. Are you charging the right price for things? It could be your renewals process. It's usually something around sales. It could also be the ability to scale technically, which is also a problem. So, I could go on and on about this. I think the answer is there are a lot of reasons startups don't quite work. The norm is actually for them not to work. It is more unusual for a startup to reach $1 billion valuation and go public than it is for a startup to fail. It's a lot more common for them to fail because there are just so many potential issues for it not to work. So it is not for the faint of heart. There will be challenges and issues all along the way. And that's why it always comes back to, is this team the team that can solve those challenges and navigate those waters? And if something is not working, be honest about it and either change it or figure out how to make it better, right? That's what we're looking for. But almost too much to count, too much to articulate what could possibly go wrong. A lot of things could go wrong.
Yeah, just when you think it might go well, there's going to be something else.
It's always like that too. It's like just when you think things are going well, something horrible happens, and then in the opposite, just when you think the company's about to die, something amazing will happen. It is a roller coaster. It is an emotional and and physical roller coaster going up and down on a daily basis. And you learn a lot. You learn way more in a startup than you can, especially a high growth startup, than you can in other jobs. But it's a lot, and there's a lot of burnout. There's a lot of divorces in the founder community. There's a lot of depression. There's a lot of really crazy things that happen as a result. It pushes you to your limit, and you see what you're made of. And sometimes that's good, and sometimes there's some scary stuff there.
Yeah, I can only imagine. I am such a creature of habit. Like, yep, nope, I'm comfortable. It's fine. Leave me alone. Got this. But I want to come back to. You talked about questions that founders should be asking VCs. Do you have any more that, because we want to make sure that you're getting the right fit on both sides. So how do founders find that out?
Yep. Again, it's by asking questions. I say that I'm basically a professional question asker. That's kind of my job, at least at the investment piece of it. There's a lot more we do to support our portfolio, but I think in return, founders should make sure they're asking questions. If this is a one-sided conversation, it's not a good conversation. Meaning, if they're only talking about their business and themselves and what they're doing, then you're not getting the information you need. So I think we talked about asking generally about the fund, about what they invest in, what's the thesis, what size checks do they write, what types of things they like investing. Are there things that they won't invest in? And it's totally fair to say, based on what you've heard about my business, is this the fit with your thesis? Mm-hmm. Is this the right thing? I think the other thing that founders don't ask nearly enough is about process, right? How long does it take for you to make an investment? What's the next step? What can I expect if we get to the end with you of this process? Like, how long does that typically take? What's your check size? Do you lead or follow? So leading a deal would be setting the terms and taking the largest position in the company, meaning writing the biggest check, mm-hmm. Typically taking a board seat. That's a very different investor conversation than someone who follows or participates in a round, meaning they're just adding a check to the terms that someone else sets. They usually don't have a board seat or much influence, although can certainly have a great relationship with the founder still. But those are very different conversations. So do they lead? Do they not lead? Or do they lead sometimes? And if so, when? I think also ask about fund cycles. How are you? Like, where are you in the cycle of your fund? Does that make a difference to how you think about investing? I think also the other thing, it depends on who you're talking to, is who is the right person in the fund that would be the biggest advocate of this. So, for example, if you're talking to an associate at the beginning, the associates are wonderful and they're great entry points very often. Usually, a lot of times our associates will take the first pitch before they pass it on to me. But they're not ultimately the people who vote on the deal, and there has to be one partner who is really advocating for the deal. So if you're not landing at that partner, then you're not at the right person. So making sure that you're connected to the right person who's really going to own this deal for their fund, advocate for you in the investment committee, and then be your main point of contact after the investment. And so there's a lot of questions, but I would just say be curious, ask questions, ask about them personally too. So are you, what do you personally like your relationship to be with founders? I like to have a pretty hands-on relationship. Some investors don't, and they like to be passive investors, and that's fine too, but understanding what that means. And then the last thing I would say is always get references from their portfolio company. So I would say don't do this at the very beginning, but if it looks like the investor is very likely to make an investment or to offer to make an investment, ask for 2 or 3 other CEOs that they have invested in the past where they have a good relationship. It doesn't matter. I actually prefer if people hear the negative things too.
Yeah.
So that you understand what it's like working with that VC. I would also probably make a big effort to reach out to other founders who they don't suggest, just like we do when we get references for the founders.
Mm-hmm.
If a founder gives us a list of 3 references, we will certainly call those references. But then I'll also reach out to 3 other people who also know that founder, because of course, when you give references, you only give references to the people who are going to give you a good reference. I want to hear the other references also, and I think you should do the same for your VCs.
Yeah. It's like a little money background check. And then you had also talked about not taking rejection personally. We hear that pretty often from founders. Like, yeah, getting your funding rejected, it kind of stings. I take it personally. I think, maybe my business isn't going to survive or whatever. But do you have any tips from your side to kind of keep their momentum going and kind of keep the fire in the search to keep looking?
Yeah, exactly. So again, this is not necessarily a reflection on you personally. It's hard sometimes. I've been there, right? Like when you're building a business, as I said, like you eat, sleep, drink, everything is about the business. And so when someone says no to something that you actually want, you can take it personally. But I think it's really important to not think like that and get feedback on these things so that you can either adapt or ignore that feedback, right? So I think that there's no other way to do it other than just be really confident in yourself. Know that it's not coming with malicious intention. It's really just about fit for thesis. And then also know that this is extremely difficult, right? I don't know what the numbers are recently, but I think less than 10% of startups raise venture capital. So it's not like every company out there, every startup out there raises venture capital. It's an extremely hard thing to do.
Yeah.
And give yourself some credit for even getting the conversations. A lot of people never get to that stage, right? So if you're even, speaking to venture capitalists, they seem interested in what you're doing, you're going through the process, then that's something that most people don't actually get to that stage. Taking no for an answer is something that I really think is important to do well, because it means if you're not getting no's when you're trying to do things, you're not being ambitious enough, right? If you're not selling if you're getting yeses from every single person you sell to, it means that you should be selling to bigger companies or more companies or something like that. You need to be really pressing the limits of what is possible, and that means getting yeses sometimes and getting no's sometimes. If you're not getting any yeses at all, it means that maybe there is something in your business that is not quite right for venture capital as an asset class, which again does not reflect on you personally. It does not necessarily reflect on your business, but it means that maybe this type of capital is not the right capital for you as well. And there is no problem with that too. It's all of these things I think every no you can learn from. And so take no as what can I learn from this experience? It might very well be that person's an idiot and they're missing out on a big opportunity. Great. But if I didn't land my vision, like if they don't see my vision, that's also a reflection on how I'm communicating. So maybe I can learn how to communicate my vision better. So next time they'll see how exciting the thing is that I'm trying to do. So I would just say take every no as a learning opportunity, both for yourself and for understanding the industry and the type of thing that you're doing, and learn from it. And you're going to get stronger and do better every single time.
I need you to like pep talk me in the mornings now because I feel better about my life and it's not even my money. And as far as industries, we are in a kind of like tech first. There's tech all over the place, but are there industries that you're seeing receive or secure VC funding more frequently than others right now?
We are still in the industry. We are still in the business of funding technology companies, and that means that company has to have tech margins. And so, what I would say is the companies that are more challenging to fund from a venture capital perspective are companies that have margins, meaning the cost of doing business versus the revenue that you get in is less than something like 80%. So we're looking for real software margins. So if you're not making on everything that you sell, if you're not making 80% of that in profit or at least operating capital, right? If your costs to sell that widget, whatever the thing is, are more than 20% of the actual cost, then it's probably not a software business, and we will, and that is going to be appealing to venture capitalists. There are, of course, some exceptions. There are some funds that look at different types of businesses, but what we typically want to see is very strong margins, and what that means is that it's scalable, right? So it's not, I put in 1 hour and I charge a 20%, uptick on what my hourly rate is, and therefore, every time I'm making a little bit of money, but I have to put in more. Like we want to see companies that can go from, here to here, logarithmically, not linearly. And that means having really, really strong margins and being able to sell in a more bulk way, meaning that the bigger you get, the more you can sell with fewer team members. And so those margins might not be 80% gross margin at the beginning, but they certainly should be able to get there if you have the right amount of capital, and it should be higher margins the bigger you get.
Gotcha. And as far as, are there any industries that you're like, man, I want to work with them all the time? Like anything that really excites you that you want to just invest in?
I mean, this is a personal thing for every investor, but I have gone extremely deep down the Web3 rabbit hole. And so I get very excited by blockchain and crypto companies now. And it is kind of hard. I invest in a very diversified group of companies that are all enterprise software. But I've been working in the blockchain and crypto space and investing in that space for 6-7 years now. And right now is a really, really interesting moment. And so it is both good and bad. I love investing in a down market, and right now we're in kind of an interesting place. But I think it's something that a lot of investors have come on board with in the last few years. I remember being very early as a professional investor in the space, and not all investors understood it or were interested. Almost every VC fund has at least someone looking at the space now, which is exciting. My particular interest is always enterprise blockchain, which is also not everyone's cup of tea, but it's where I think the most opportunity is. And when you see things that are truly industry changing, and not just industry changing, like world changing in some way, like meaning the way we do things in Web3 is very different than the way that we do things now, and it is an improvement, meaning, I am able to capture ownership in the things that I participate in. That's a big concept that actually has some pretty radical downstream impacts. And it's hard to look at companies that are doing incremental changes when you see things that could potentially have a really, really massive change. So for everyone, that's different. But for me, it's focused on enterprise applications for blockchain.
Ethan loves blockchain and crypto.
Oh, for sure.
Meanwhile, I'm like, I don't know what that means. So first of all, if I could just congratulate you on just the never-ending knowledge that I would just like, wow. I knew you were subject matter expert, but I'm just like, it's amazing. All right. So what are some common mistakes that you see startups make when seeking venture capital?
Again, a lot of mistakes. I think our industry is full of, call it rawness, right? Again, we're not expecting fully formed businesses or even fully formed founders, right? This is a work in progress. The one indicator we like to see is like, can you grow and develop and get more sophisticated quickly, both you and the business? I think a lot of mistakes happen when there is a lack of understanding of what venture capital is,
Mm-hmm.
or secondly, and this is part of it, that this is a human relationship, right? So, for example, I know you like never feel bad for your VCs, but just for some context, I sit and listen to some days to pitch calls like, for 6 hours straight on Zoom. That is not necessarily the most glamorous or fun day for me. It's
Mm-hmm.
not that the companies aren't interesting, but if it's not engaging, then I'm probably not going to be interested in your company. Meaning, like, ask questions. Let's have a real conversation. Figure out how to make it interesting. Because I get really excited by companies and people that I think are interesting. But if you're going to sit there for my 30 minutes that we have, and I ask you, hi, can you tell me a little bit about your business? And then you speak for the next 30 minutes without asking a question, and you go through slide after slide after slide in a robotic way. That's not fun for me. I don't want to work with you. Like
Yeah.
so there's a real human. It could be the most like amazing business in the world, but this is a people business. And so make sure that you're appreciating that there's a person on the other side of the pitch, and it's not just about the pitch, it's about the relationship. So make sure you're really focusing on that relationship. And sometimes that means not even talking about the business, talking about your story and what you care about and why the industry needs changing, and not doing a robotic pitch. I would say just be really conscious of how what you're saying and what you're communicating is being received by the person on the other side of it. And if they're sitting there looking like they're multitasking on Zoom or they're not really engaged, it's probably not landing. So either change what you're doing or just end it because it's not working.
At the beginning of the relationship between founder and VC firms, it seems like everyone is in alignment. Make the company grow as fast as possible. The check is cut, the bottles are popping. Everyone gets to celebrate the future prosperity that's just right now being born. But a few years down the road, if the goals fall out of alignment for any number of reasons that this could happen, is there any way forward that doesn't lead to destruction for the company or a loss for the VC?
Of course, there's plenty of ways to pivot or to repair something that's not working. So I think number one is if it's a people problem, you change the people. That could be head of sales. It could be the CTO. There are certainly people that are really good early stage founders or early stage executives that don't scale with the business, and so they hit a personal maximum point where they just aren't the right person for that thing anymore. And sometimes you can bring in a new executive and have some fresh energy and fresh experience, and then the company can really take off. Sometimes it's pivoting what the product does or how it's sold, right? You can go from, for example, a direct sales model to channel partnership. So instead of selling directly to the customer, you go through a variety of third parties who are already selling into that customer, and you do partnership agreements with them. That's on the enterprise side. Of course, there's other ways to do that on the consumer side. There's also, fundamentally, like, is the technology being applied in the right way to the right problem and the right business? I've seen companies, and there's lots of examples of this, where they start with a tech product that does one thing in an industry, but then actually pivots and is like much better served doing something else. And I think that there's, it's, again, all of this is about fit. So I think there's certainly ways to revive. And like I said, the startup world is a roller coaster. And when you hit a kind of down point on that roller coaster, I think having a real hard self-reflection on, is this just a normal down cycle and we'll come back up, or is this really problematic and we have to change something? And if we change something, will it go back up? I think that those are just not only, not like one time in the life of a company. That happens on a monthly, quarterly, annual, maybe even daily basis. And so it's about problem solving. And if something has plateaued and something's not working, the responsibility of the founders with their investors as coaches is to figure out how serious that problem is and how you fix that problem.
Cool. I like to hear that it's not just like, well, shut it down. Couldn't work.
It's not. The other thing you see on a regular basis is early acquisitions, right? So if there's something interesting there, but and we've seen this too, where a founder who goes, okay, this is really interesting, the tech is really valuable, but it's probably not going to scale in the way we need it to hit those kind of 10x returns. We're probably not going to be able to go and raise another round of venture capital just because the growth isn't there. So, but it's still a good business and we're still making money and there's still really interesting opportunities for the tech. Then you see an early acquisition, right? It might not be a 10x return, maybe it's a 2 or 3x return, but that's okay. It's better to do that than to try to burn through the cash you have in the bank and run out of money and shut the business down. So there are certainly, again, all of this is kind of decision making and there's kind of like decision trees at each stage. But if you hit that point where the company's just not working at the scale that you need it to, you have options. If something's working, right? If nothing is working, yes, the company's probably going to shut down. But if something is there that is actually working, there are multiple different paths to go with that.
So Mindset Ventures is based in Nashville. Are you seeing a shift in where startups are located post the height of the pandemic? And if so, is there a shift toward virtual pitches? It sounds like you said you spend 6 hours a day on Zoom sometimes, so maybe the answer to that is yes.
This has been a really interesting change in the industry. So just to be really clear, my fund is actually an international fund. Most of our team is based in Brazil. We also have an office in Israel, and then I'm the U.S. partner, and I cover the U.S. and Canada. However, I was in New York. I was in San Francisco before that. And then I moved to Nashville personally. So I'm the only team member here, actually, although I am the head of the US. So I guess it's technically based here. And I came here for personal reasons after the pandemic. I didn't want to be in New York. I was pregnant at the time and did not want to be having a baby in a 1-bedroom apartment in New York when everything was shut down in the middle of a pandemic. That was not exciting to me. So I moved closer to my family in Nashville. That would not have been possible 2 or 3 years ago. That was really a result of COVID. This is an interesting ecosystem, but it is certainly not one that I would have ever selected to be in for my career. But the beautiful thing that happened with COVID, and I will be ever thankful for that, is that people have learned that you don't actually need to be in New York or San Francisco in order to run a good startup, to be a good investor, to do most of the things we do. That being said, there are still some things I like to do in person. I do like to meet the founders before we make an investment. Sometimes we don't, and they've gone just fine. But a lot of times you get a lot of good information and you build a better relationship with at least a little bit of FaceTime. That doesn't need to be the first pitch. That can be, before we make an investment, maybe I'll go visit you in wherever you are, see your team, see the office and check it out. I also do a lot of traveling to conferences and to other things that are where we might start a relationship. So like meet someone for the first time, have a coffee, and then go down the path after that. But I've already met you in person, so I have a little bit of data there too. So I think we are all learning how to navigate in this new world, but I am fully taking advantage of it by moving myself to a non-traditional city where you wouldn't normally see a lot of VCs. And actually, I think in the last 18 months, there have been quite a few investors that have moved here since then for the similar reason. So what's happening is that you're seeing a little bit more of a diaspora in the startup world where people are kind of working from everywhere. And I think that works to a degree. I will say there are some challenges with it and it's not always ideal, but there are enough good things about it that I think it's not going away.
Yeah, well, and Nashville's gorgeous, so I would be with you on that one. And you've had a lot of advice throughout this entire interview. Can you boil it down to your number one piece of advice for young founders starting their first company who are looking to raise venture capital?
If you can show growth, you can raise venture capital. So if you can grow at those paces that I've talked about, which is 100, 200, 300% a year, then there will be interest from venture. And if that is sustainable, then for several years, there will be interest from the venture industry. And then it's up to you. Do you want to take venture capital or not? It's not always the right path. And so really understand it and make sure that it's the train you want to get on. Because once you get on the train, you're on the train. You can't get off. You either smash into a rock or you hit your destination. Yeah. And you need to understand the train that you're getting on. But if you get on, it's going to be a really interesting ride. You're going to learn a lot. And maybe at the end of the day, have some just personal, wealth experiences that are going to completely change the direction of your life. But it could also fail, and you have to understand that risk.
All right. Well, thank you very much for coming on today. I think your answers have been supremely excellent for all those founders out there who were like, maybe venture capital, maybe not. And now I think they know. And we have you to thank for that. So we really appreciate it.
I don't think anyone really knows, but if I could help people know just a tiny bit more, then we've done our job here. So thanks for having me. And hopefully this is the beginning of a much longer conversation for the folks who are listening. And good luck.
All right, that's going to be all for today's episode of the Startup Savants podcast. Thanks for hanging out with us today. So, as you heard, today's episode was a little different. We'd like to hear your opinion on the show, featuring some industry experts alongside the awesome founders we normally speak with. Personally, I think it was awesome, but we really want to hear what you think. So let us know your thoughts by sending an email to podcast@startupsavant.com. Of course, I'll beat my normal drum as well. Head on over to Apple Podcasts and leave us a 5-star rating. We love that, and we love to see when you do it. Thank you very much. We appreciate you just so much more than you know. For tools, guides, videos, startup stories, and so much more, head over to truic.com. That's truic.com, TRUIC.com. See you, folks.
Bye, everyone.